Hello and welcome to this video. In this video, I would like to demonstrate how to measure the risk of a single stock. For this video, I planned the following. Well, this is only a one-slide video, and on this slide, I would like to go into the distribution of stock log returns. So we're going to use log returns here instead of simple returns. Nevertheless, in another video I have shown why log returns are to be preferred against simple returns. Then we're going to calculate the variance of stock log returns, and we're going to calculate the standard deviation of stock log returns that are called volatility. And we're going to annualize the variance and the standard deviation. Okay, on this slide we see the distribution of stock log returns. As an example, I chose the distribution of Adidas stock log returns in a certain period of time that is not so interesting here. So what do we see here? First of all, we see the mean. So obviously in this period of time that I chose, Adidas lost on average 0.0005, which is equivalent to 0.05%. And we see that also since the arithmetic means deviate slightly from 0. But we also see that these log returns are distributed around the mean. If they were not distributed, if they were constant, of course we wouldn't see any risk. This is typically the case for very secure investments, just like governmental bonds or whatsoever. But here we see strong deviations, so we see a certain risk, and this risk is presented as a distribution. Of course, we know measures of distribution, and that is typically the variance and the standard deviation. So the variance is typically only an in-between step for the calculation of the standard deviation. So here we see the daily variance. I just switch to a red pen so that I can explain what is done here. So here we see the return of this stock, in this case Adidas, of a certain day T, as denotes the stock, which is in this case Adidas. And we subtract the average. We could also put a line on top here. So this is the average daily stock return that we subtract. Of course, we square it since it is the variance, and we add them all up and divide by T. It's a time series here, so that's why we have capital T here and not capital N. And accordingly, we calculate the variance of this stock of Adidas. Of course, this is a daily variance. Now, if we want to annualize this to make it comparable to other annualized numbers, we need to multiply by 250. And 250 is the number of trading days. Well, why can we simply multiply by 250? Because the variance is additive and also multiplicative, so 250 times this variance is simply the annual variance. Of course, this is not true for the standard deviation. The standard deviation, we know that, is simply the square root of the variance. So here we have the daily standard variance, standard deviation, And if we want to annualize this one, we have to multiply by the square root of 250. Well, in this picture, we can simply see the daily standard deviation because it is shown here. So here we see the standard deviation of Adidas. And here again, so from this point to this point is one standard deviation, and from this point to this point is another standard deviation. So here we see 2 times the standard deviation. Why is it exactly this point? It's exactly where the curve goes from a left curve to a right curve and back again. So these points, the curvature changes. And that's very typical for normal distribution here. Of course, as a kind of risk measure, we can also use further. So in risk management, we often use 6 sigma. 6 sigma means not 2 standard deviation, but 6. Nevertheless, what else do we see here? So here the standard deviation is calculated. It is 0.0253, so that's comparable, but keep in mind that this is daily, right? Well, there are certain downsides of normal distributions here, because what do we see here? First of all, we see these, and these are outliers. And these outliers are higher than the normal distribution that is shown here as a curve. So this curve is a normal distribution that is adopted to the mean and to the standard deviation here. So since these outliers seem to be more often than normality would predict, this is typically a problem, and we call this problem fat tails. Fat tails problem. So outliers more often than normality predicts. We have the same here on the right side. Here on the right side, here it is. So here again we have more outliers than normality would predict. The same is true here in the middle. So here, this large part of the distribution is more often than normality predicts. That means that the stock is not moving also is more often. But if we have certain regions, like the outliers on the left, like the outliers on the right, and in the middle, of course we need to have regions that are fewer, that are less often than normality predicts. And that's exactly here and here. So let's say average movements are fewer. Fewer than normality predicts. Can this be a real problem? Of course, yes. Since we use variance and standard deviation, we assume normality here, normally. And if we have outliers that are more often than normality predicts, risk models, for example, or portfolio models will underestimate these extreme risks. And as you see here on the left side, 15% loss in one day, that's quite a lot of money that you lose then. And typically this risk of extreme downsides, but also the risk of extreme increases in stock price are underestimated by normality-based portfolio systems or risk systems. Okay, so that's about the risk of a single stock. I hope this video helped you. Thank you for listening and see you in the next video.